Okay, so you want to own a vineyard in Britain. Buy some rolling chalk downland in Kent or Sussex, plant rows of Chardonnay and Pinot Noir, wait patiently for the vines to mature, and produce a genuinely excellent English sparkling wine that can hold its own against champagne itself. That is the plan in your head. And unlike a great many of the businesses this channel has covered, this one comes with a genuinely unusual twist. Because for once, a major, slow-moving global trend is actually working in this particular British business's favor rather than against it. Visit a well-established English vineyard on a warm September afternoon. Rows of vines heavy with fruit stretching across genuinely beautiful chalk downland. A tasting room doing brisk trade with visitors genuinely impressed by what is in their glass. And you think, this must be one of the more exciting growth stories in British agriculture right now. You would, in this specific case, actually be onto something real, but here is the more complicated truth sitting underneath that genuine excitement. A British vineyard is caught between two enormous, opposing structural forces at once. A warming climate genuinely, measurably improving the underlying conditions for growing quality wine grapes on British soil for the first time in centuries, set directly against a considerably less friendly set of post-Brexit labor and trade pressures, making the actual business of running that vineyard meaningfully harder than it would have been just a decade ago. Understanding both of those forces together, pulling in genuinely opposite directions, is the key to understanding this remarkable, genuinely unusual British industry. Let us start with the genuinely favorable half of this story, because it deserves real, honest attention before we get to the harder parts. The chalk soil running beneath large parts of Kent, Sussex, and Hampshire is, geologically, the exact same chalk formation that runs beneath the Champagne region of France. A formation that provides precisely the drainage and mineral characteristics that region's producers have spent centuries proving ideal for growing the classic Chardonnay, Pinot Noir, and Pinot Meunier grape varieties used in traditional method sparkling wine production. For most of Britain's modern history, this geological advantage sat essentially unusable because the British climate was simply too cool and too unpredictable to reliably ripen these specific grape varieties to the quality and consistency a genuinely fine, sparkling wine requires. What has changed, genuinely and measurably, over recent decades is the climate itself. Meteorological data covering southern England has shown a real, sustained warming trend, and that warming has moved the effective growing conditions across this specific chalk belt considerably closer to the conditions Champagne itself enjoyed several decades ago, before its own warming climate began pushing that region's growing conditions in turn toward what were historically warmer wine regions further south. This is precisely why a considerable number of respected French champagne houses, businesses with centuries of accumulated expertise in exactly this style of wine production, have made the genuinely significant decision to invest directly in English vineyard land over the past 15 to 20 years. A considerably more powerful vote of confidence in this specific region's long-term potential than any marketing claim from an English producer alone could ever provide. Now here is where the naive mental model starts to break down, because even with this genuinely favorable geological and climatic tailwind, the actual economics of establishing and running a British vineyard remain genuinely demanding and in several important respects considerably harder than the general vineyard economics explored elsewhere on this channel would suggest. Precisely because of factors specific to operating in Britain today. Suitable vineyard land across the established English sparkling wine regions has seen genuinely significant price appreciation over the past 15 years. Precisely because the growing recognition of this land's genuine wine-producing potential has drawn considerable investor and producer interest into a genuinely limited supply of chalk belt land within the right climatic band, meaning the cost of actually acquiring appropriate land today runs considerably higher on a per-acre basis than it did for the earlier pioneers of this industry a couple of decades ago. A genuine cost disadvantage facing anyone entering this specific business, now relative to the founders who recognized this opportunity earliest. Now, the multi-year establishment timeline, and this applies here with the same fundamental force explored in the general vineyard breakdown elsewhere on this channel. A newly planted vine simply does not produce commercially viable fruit for several years, and genuinely mature, high-quality fruit takes considerably longer still, meaning an owner establishing a new English vineyard today is committing to funding several consecutive years of full vineyard establishment and farming costs. Land preparation, trellising, irrigation infrastructure, ongoing vine training and disease management before generating any meaningful revenue at all. And traditional method sparkling wine production specifically requires additional aging time on the lees after the base wine is made, extending the total gap between planting a vine and actually having a finished sellable bottle of English sparkling wine to a period genuinely comparable to, or in some cases, longer than, the equivalent timeline for a still wine vineyard anywhere else in the world. Now, frost, and this remains a genuinely severe, genuinely underappreciated risk specific to growing grapes this far north. Even accounting for the broader climate warming described earlier, English vineyards remain considerably more exposed to a single, catastrophic late spring frost event than vineyards in more established, more southerly wine regions. Because Britain's growing season still sits close enough to the genuine margin of viability for these grape varieties that a single hard frost hitting at exactly the wrong moment in a vine's early spring growth can still destroy a meaningful share of an entire year's crop across an affected vineyard. Precisely the same catastrophic single-event risk explored in the general vineyard breakdown elsewhere on this channel, but applied here to a region where the underlying climate, while genuinely warming on average, has not eliminated the risk of a specific late frost event in any individual year. And a number of English vineyards have experienced exactly this kind of significant single-season crop loss in recent years, a sobering reminder that a favorable long-term average climate trend does not eliminate the very real year-to-year weather volatility that can still devastate a single harvest. Now, the considerably less favorable half of this story, the genuine structural headwind Brexit has introduced to this specific industry, and it operates on two separate fronts simultaneously. The first is labor. Vineyard work, particularly the labor-intensive periods of pruning, canopy management, and harvest itself, has historically depended considerably on seasonal agricultural labor drawn from across the European Union. Workers who could previously move freely into Britain for exactly this kind of seasonal farm work, without the visa and immigration complexity that now applies. Since Britain's departure from the European Union, accessing this same seasonal labor pool has become considerably more complicated and considerably more costly, requiring navigation of a specific seasonal agricultural worker visa scheme rather than the free movement previously available. And the industry has consistently reported genuine, ongoing difficulty securing sufficient harvest labor at exactly the volume and reliability the industry's rapid recent growth has demanded. A genuine, structural cost and operational pressure that simply did not exist for this industry's earlier pioneers operating before this policy shift took effect. Now, the second front. Export friction into the European Union market specifically. a genuinely significant complication for an industry whose most natural, most geographically obvious export market, the wine-consuming nations of continental Europe, sits directly across a body of water that now carries considerably more customs and regulatory friction than it did when Britain remained inside the European Union's single market. Exporting English sparkling wine into EU member states now requires navigating customs declarations, potential tariff considerations depending on the specific trade terms in place, and additional regulatory paperwork that simply did not exist for British wine exporters selling into these exact same markets before Brexit took effect. A genuine, ongoing administrative and cost burden that makes the natural, geographically logical expansion of English sparkling wine into its closest large wine-consuming market considerably more complicated than the underlying quality of the product alone would ever suggest it should be. Now we get to the part of this business that actually explains everything else, and it is how these two opposing forces, a genuinely favorable long-term climate trend and a genuinely unfavorable post-Brexit labor and trade environment, actually interact with each other in practice, because they do not simply cancel each other out. They create a genuinely distinctive, genuinely two-sided risk and reward profile unique to this specific industry at this specific moment in its development. The climate trend represents a slow, multi-decade tailwind, genuinely difficult to reverse and genuinely likely to continue improving the underlying growing conditions across this region over the coming years. A structural advantage that compounds favorably the longer an owner is patient enough to hold their vineyard investment. The Brexit-related labor and export friction, by contrast, represents a considerably more immediate, considerably more year-to-year operational cost and complexity. One that could, in principle, ease somewhat through future policy adjustments or through the industry, gradually adapting its labor sourcing and export logistics. But that currently sits as a genuine, persistent drag on the economics of actually running the business day to day, even while the underlying long-term growing conditions continue improving in the industry's favor. Now, land value and the investment dynamic this favorable climate story has created, echoing, in an interesting way, the prestige asset dynamic explored in the racehorse breakdown elsewhere on this channel. A meaningful share of the capital flowing into English vineyard land in recent years has come not purely from operators intending to run a commercially self-sufficient wine business from day one, but from investors, including a number of genuinely wealthy individuals and, as mentioned, established international wine businesses. Viewing English vineyard land as a genuinely attractive long-term asset, betting on continued climate-driven appreciation in both the land's underlying value and the quality of wine it can eventually produce. A dynamic that has helped drive considerable investment and genuine expertise into the industry. But that has also, as described earlier, pushed land acquisition costs up meaningfully for anyone now trying to enter this specific business without that same depth of patient, long-horizon capital behind them. Now, the distribution and route-to-market question, a genuinely important structural consideration specific to how English sparkling wine has actually built its reputation and its customer base to date. A considerable number of the industry's most successful producers have built their business heavily around direct-to-consumer sales, cellar door tastings, wine club subscriptions, and direct sales to UK restaurants and independent wine merchants, rather than depending primarily on large-scale supermarket listings or, until quite recently, significant export volume. A strategy that has allowed producers to capture considerably stronger margin per bottle than a supermarket-dependent distribution model would typically provide. Echoing, in its structure, the direct-to-consumer emphasis explored in the general vineyard breakdown elsewhere on this channel. but carrying particular importance here, given the export friction described above, has made building a strong, resilient domestic direct sales channel considerably more strategically important for English producers than it might be for a vineyard in a country with easier access to its natural neighboring export markets. There is a structural choice sitting underneath all of this worth understanding. And it is the decision between focusing entirely on the premium, traditional method sparkling wine category that has built the industry's genuine international reputation versus diversifying into still wine production as well, which carries a considerably shorter path from harvest to sellable bottle, since it skips the extended aging on the lees that sparkling wine production requires, providing a considerably faster, if generally lower margin, cash flow to help a producer bridge the genuinely long multi-year gap before its sparkling wine program reaches full, mature production and revenue. There is also a wrinkle worth understanding around the genuinely growing recognition English sparkling wine has earned in blind tasting competitions against established champagne houses over recent years. A form of credibility that has proven genuinely important to the industry's ability to command premium pricing, because unlike an established, centuries-old wine region whose reputation is essentially assumed by consumers, English sparkling wine has needed to actively, repeatedly prove its quality against the world's most prestigious sparkling wine benchmark before a broader consumer base was willing to pay champagne-comparable prices for a genuinely new, unfamiliar regional product, a credibility-building process that took the industry's pioneering producers considerable time and considerable consistent quality to actually achieve. Now, here is where the financial fragility becomes just as important as a warm September harvest afternoon looks. Why does an industry benefiting from such a genuinely favorable long-term structural trend still describe real, ongoing operational difficulty? The pattern is structural. The multi-year establishment timeline and the genuine, persistent frost risk explored in the general Vineyard breakdown apply here with full force. Regardless of the broader favorable climate trend, land acquisition costs have risen considerably as the industry's genuine success has attracted considerable outside investment into a limited supply of appropriate chalk belt land. And the post-Brexit labor and export friction described throughout this breakdown adds a genuine, ongoing operational cost and complexity that simply did not exist for this industry's earliest pioneers. Meaning even a business benefiting from genuinely improving underlying growing conditions still has to navigate a genuinely demanding, genuinely capital-intensive, and now considerably more operationally complicated path to sustained profitability. So how does a British vineyard actually make money in plain mechanical terms once you strip away both the favorable climate story and the Brexit-related headwinds? The core engine, once a vineyard finally reaches full, mature production, is cases of sparkling and still wine produced and sold, weighted heavily toward the considerably higher margin direct-to-consumer channel given the export friction described above, minus the ongoing cost of farming the vines, including increasingly costly and increasingly difficult to source seasonal labor, minus the extended aging cost specific to traditional method sparkling wine production, minus the fixed cost of a tasting room and cellar door operation, and minus, for a business exporting into the European Union at all, the additional administrative and customs cost that specific market now carries. A mature, well-established English sparkling wine producer, selling primarily direct to UK consumers and UK trade, at price points that have genuinely earned the credibility to compete directly with mid-tier champagne pricing, can generate a genuinely strong return on the considerable capital and considerable patience required to reach that point. But the path to that mature, profitable position remains genuinely long and genuinely demanding. Considerably more so today, given rising land costs and post-Brexit labor and export friction, than it was for the industry's earliest pioneers establishing their vineyards 2 or 3 decades ago. Now let us put all of this together and look at what actually happens over the life of a British vineyard's ownership journey today. Because this is where the two very different versions of this story reveal themselves. In the optimistic scenario, an owner has secured land within the established, proven chalk belt regions at a price that still allows for a genuinely sound long-term return, has built a resilient labor sourcing strategy that navigates the post-Brexit seasonal workers scheme reliably enough to secure harvest labor year after year, has invested in a strong direct-to-consumer sales channel that reduces dependence on the more friction-laden European export market, and has been fortunate enough to avoid a genuinely catastrophic frost event during the vineyard's critical early establishment years. Under those conditions, a British vineyard can benefit genuinely, powerfully from the same long-term climate tailwind that has already drawn considerable international wine industry investment into this exact region. Building a business with real long-term appreciation potential in both its wine quality and its underlying land value. In the more difficult scenario, rising land acquisition costs, persistent frost risk, and the genuine, ongoing labor and export friction Brexit has introduced combine to make the already long, already capital-intensive path to vineyard profitability considerably harder than it needs to be. Even while the underlying climate conditions continue slowly and steadily, improving in the industry's favor. So, if you do decide to plant a vineyard in Britain, remember the one thing that actually determines whether the eventual bottle in someone's glass represents a genuinely sound financial decision. It was never really about whether the climate would eventually cooperate. The geology and the warming trend across this specific region genuinely have been moving in your favor for years now. It is about whether you can navigate the genuinely harder labor and export environment this industry now operates within long enough to actually benefit from the patient, multi-decade tailwind that first drew the world's most prestigious champagne houses to plant their own vines in exactly the same English chalk you are considering today. If this kind of breakdown helps you see a business differently, that is exactly what this channel is built around. Subscribe to Money Framework British for more deep dives into how everyday businesses really make their money behind the scenes, and turn on notifications so you never miss the next one.